How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. And today's topic, I want to discuss with you Index Annuities 101 and what is a fixed index annuity, and see whether or not it may be beneficial for your specific retirement situation. Index annuities became very popular in more recent years because of the potential for growth with upward market movements. Without falling victim to inflation risk and without falling victim to the low interest rate environment that we are currently sitting in. What do I mean by that? Well, it used to be very simple to do retirement planning or retirement income planning. An individual was able to take money, place it into a bank CD, a treasury bond, a fixed annuity, take their dollar amounts, place it into this, essentially look at it as a bucket, maybe it's $100,000, throw it into a fixed account and get a fixed interest rate year by year by year. Back in the 90s, you had double digit figures where someone could leverage their dollars properly. They could go and they could say if they had $100,000 and let's say a 5-year bank CD was paying 10%, or a 5-year fixed annuity was paying 10%. They understand that every single year, if they use $100,000, they'll be able to receive $10,000 per year and live off of that for pure income. At the end of those 5 years, they would have $100,000 that's still sitting there, and they could now purchase a new 5-year bank CD or a new 5-year fixed annuity. Well, since interest rates have hit all-time lows and they have stayed in a very, very low, because the Fed has obviously decreased those interest rates. They do not want inflation going out of control. So what it results in is individuals trying to find alternatives to get decent market growth, or at least market growth that could either give them retirement income or could just make sure that their accounts are preserved and protected and they're beating the pace of inflation. Now, rule of thumb is that inflation increases by about 3% per year. This is anything from the cost of goods sold. A gallon of gas 20 years ago was a lot cheaper than a gallon of gas today. Milk 20 years ago was a lot cheaper than milk today, etc. So we understand that the prices of the costs of goods and services are increasing roughly by rule of thumb about 3% every year. So rather than go and say, okay, well, I understand I can't really place my money in a fixed account because if you have a 5-year bank CD, rather than that paying 10%, maybe a 5-year bank CD is now paying you 1.2%. A 5-year fixed annuity, maybe rather than that paying you 12% in previous years, now that 5-year fixed annuity, you'll be lucky if you could find something right around 3%. So these interest rates staying low has significantly impacted individuals that have that safe, consistent mindset going into retirement or just going into safe money planning. Now, an index annuity was created to allow this individual to not fall victim to downward market losses, but still be able to increase their return better than anything that's currently sitting there in a fixed interest rate or fixed interest rate account. So you could set up a fixed index annuity in a couple different ways. You could have a fixed index annuity. You could set it up in like a 6-year product. You could set up an 8-year product, 10-year product. And understand that the longer that you have these contracts, the higher the potential rate of return could be for your specific monies. It's because only insurance companies could offer annuities, like I've mentioned in other videos. With this type of annuity, the longer that they have it on there, the higher, the guarantee, the higher that they could give you a higher cap rate, a lower spread rate on your dollars. So if we have this individual that is now takes that $100,000 and he understands he can't throw it into a fixed annuity or a bank CD anymore because they're only paying him that 1%, that 2% per year, and he wants to have a higher growth potential, he could go and purchase a fixed indexed annuity. And what this $100,000 now does is it's going to say, okay, let's say this person purchased a 6-year fixed index annuity. It's going to say, based upon whatever index that the product that you chose, they might have a slew of indexing strategies, maybe 5 different strategies, 6 different strategies, and typically they're linked to some sort of stock market index, like an S&P 500 or Dow Jones Industrial. If you take an example of just an S&P 500, and let's say that an individual has a 10% cap rate, but with all these index annuities, we understand that your floor is 0%. What exactly does this mean? Well, this individual places $100,000 in there, and it's a 6-year product, understanding that after 6 years he could pull out all of his money plus whatever the gains were. But the set interest rate is not guaranteed. There's a question mark there. The only thing that's guaranteed is that this money will never gain less than 0%. So you never lose money due to downward market losses, or never lose money due to fees. A lot of the programs that we recommend, they don't have any fees with it if you're looking at just a straight fixed index annuity. So in an example, let's say if you chose 100% allocation to the S&P 500 with a 10% cap, and the S&P 500, let's say, gained 15% that first year, well, because the cap is 10%, you're going to receive 10% into your account. So now your new account value is going to be $110,000. And then now that's ratcheted in there. The next year, let's say the S&P 500 loses 15%. Well, because we have a floor of 0%, you're going to have a gain of 0% that year. So now you have $110,000. The next year, let's say that it goes up 5%. Well, because 5% is underneath the cap of 10%, you're going to receive the credit of 5% in there. So you're going to have that little dance happen where you're either going to gain interest or you're going to gain 0%, gain interest or gain 0%. But you understand that at the end of those 6 years, you could either live off of, some companies allow you to just pull out the interest year by year, so you could utilize that as pure income. Other companies, you just are placing your money in there so that you understand, okay, this is a short-term product, this is a 6-year product. I could just take all those gains, the power of compound interest, because we don't have any negatives that are working against that account, and then you could just take that money and roll it over into something else after 6 years. But now you have that safe, consistent growth and the power of compound interest to get you that good growth successfully, or that good growth in the best possible ways with upward market movements without falling victim to downward market losses and without falling victim to fees. Typically, if you have this money and this individual says, okay, well, I understand bank CDs are not paying good money, and fixed annuities, they're just those interest rates are too low, that fixed percentage rate, but maybe I'll go into something that's a conservative mutual funds. Well, with those mutual funds, you still fall victim. A mutual fund, you could lose all your money in a mutual fund. Doesn't matter how conservative they get. If you go and you have $100,000 in there, and the market wants to come into another 2008 and reset itself, your money is going to be severely impacted. So therefore, it's not only the fact that you're not gaining anything, but then you're also participating in a loss. Let's say even if there's a 10% drop in 1 year, well, now you're down $90,000. You never even took out any income from it, and you now fall victim to it. On top of that downward market loss potential, you could fall victim to those mutual fund related fees in there. Mutual fund related fee averaging between 0.50% to 1% per year. If it was hitting you, or 1.5%, whatever mutual funds that you place your money in. If it averaged 1%, well, you already have to now beat out that 1% just to break even. On top of it, if you're using a wealth accumulation specialist or a financial advisor up the road or wherever that is, they're most likely going to charge you a wrap fee. If they're giving you a recommendation, they're not just going to do it for free. They're going to want to try to say, oh, listen, I'm such a specialist. I'm going to put your money in a conservative allocation, and we're going to charge you 1% on this money. So therefore, you'd only have the mutual fund fee of 1%, but then you also have the advisor fee of 1%, and then the potential downward market loss of 10%. And what you're doing is you're playing that game of trying to go with an uphill battle struggle at every single year, every single point in time. The good thing to the mutual funds is you can go and pull that money out whenever you want. So understand that there's going to be some give and take with fixed index annuities, especially if you're looking for those shorter term or those longer term products. Typically, because the insurance company is giving you some sort of guarantee, they're saying 0% floor or a specific cap limit. If you had a 6-year contract, maybe your cap limit might be 10%. If you had an 8-year contract, maybe your cap limit is 15%. But we understand that your worst case scenario is 0%. On top of it, majority of the carriers that we offer, we explain to you they don't have any fees associated with that. The only negative to it is if you wanted to throw your money in there and then you say after 2 years, I want to gank all my money out, then you could get hit with a surrender charge, kind of just like a bank CD. If you try to pull your money out of a bank CD too soon, you're going to get hit with some sort of penalty for doing so. So it's very, very important that you understand at least the basics of how an index annuity works. And it works very successfully for certain individuals for that specific safe money mindset. Because we understand, okay, I'm going to gain when the market goes up, but I have that peace of mind that I'm not going to lose my principal when the market goes down. And there's some really, really neat avenues that you could do that. Also, some of the newer blended products is something known as a hybrid annuity. This is for an individual that likes the concept of their money's going to gain flatline, gain flatline, gain flatline, but they want to have a secondary aspect, a secondary benefit meant specifically for lifetime income. And that's where they attach an income rider onto their fixed index annuity, and that's what is deemed a hybrid annuity. So typically what I've seen is those types of hybrid products, they work really well for that individual that has like old IRA monies, old 401k monies, cash accounts that they were setting aside specifically for retirement income planning. And you kind of have those best of both worlds scenario while you still have access, you still have some liquidity to that account. So when I said that, after 6 years, that's when you could fully remove your money. With some of these other products, you could pull up to 10% within a given year. You could pull out interest only within a given year. So you do have that flexibility there. One of the most important things that we've just put together is something known as the Retire Sharp Planning System, also known as RPS. And what happens is when an individual calls our office, we offer 24/7 customer service. An individual will call our office. They call us up, Saturday, Sunday, nighttime, whatever it is, and you'll be speaking to a secretary. You tell the secretary, hey, listen, I was somewhat interested in a fixed index annuity. I'm not exactly sure of my plan, and they'll make sure to patch you over to a specialist dealing specifically with that niche. If you have thrift savings plan monies, there's a specific department for you. If you have monies that you want to roll over from a 401k or just regular cash accounts, non-qualified accounts, there's a specific department for you. You might be dealing with myself. You might be dealing with one of my other advisors or one of my other representatives. But from there, we're going to ask you a slew of questions. Based upon your goals and based upon what you're currently doing, it's very likely that you may be able to accomplish your goals without placing it into a fixed index annuity, without placing your money into a specific type of strategy. But for those individuals that really have that question mark, they don't know how much money to pull out for retirement. They don't know the safe aspects of retirement, and they need help along the way. That's where our Retire Sharp planning system works perfectly. And what we do is if we understand that you have a specific income goal, you have a certain safe money goal, and there's a gap there, we go through over 1,200 different strategies and product lines in your specific area, making sure that you will have the best possible benefits. You'll have the best product, you'll have the best strategy, and we'll say, okay, listen, you have 3 major options, the top 3 options that came back. Option A, these are the pros, these are the cons. Option B, these are the pros, these are the cons. Option C, these are the pros, these are the cons. And we do this, we utilize a proprietary system, a strategy that majority of advisors throughout the nation do not have access to. We are A+ rated on the Better Business Bureau. We've always had good reviews. We've never had any complaints, and it's because of this methodical process. We teach you through either literature pieces, through personalized videos, different things that help you get fully educated off of your specific situation so that you could get from point A to point B successfully. Point B is your preservation. This is your retirement income stage. This is your safe money planning stage. And how exactly can you do it confidently? How exactly could you use our resources available through our different case design departments and make sure that you're comfortable with the process every step of the way. Depending upon whatever your area is, give us a call, 1-800-566-1002. Hopefully I'll be able to speak with you. If not, one of my representatives that I've hand trained will be able to speak with you as well. Definitely look forward to your phone call. I want to thank you very much for watching this video. Please make sure to subscribe to our YouTube channel, Retire Sharp. You could also visit our website at retiresharp.com. But at any point in time, if these things are appealing to you in any way, give our 1-800 number a call, 1-800-566-1002. When you subscribe to our YouTube channel, Retire Sharp, there's no spaces, it's just one word. You'll have access to all the most updated videos. We try to update videos weekly, making sure that we're giving you as much free content as possible. Thank you so much, and I hope that you enjoy.